Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Emerging market stocks rose today on hopes that the US and China can settle their differences on a trade. We saw MSCI's index of developing world stocks rising about 0.3%. Of course, as encouraging results from Apple also helped to boost markets. Now on the continent, South Africa's JSE was slightly weaker today. Gains amongst gold miners failed to offset a slump by retail giant Shoprite. The retailer's shares fell almost 20% on the day. That's after a profit warning. Of course, more on that are coming up in a few. But first, here's a look at what's on the show today. Government representatives and union leaders locked in talks to avert a nationwide strike in Zimbabwe. South Africa's leading retailers' shares tumble after a profit warning. And a boon for Egypt's economy as foreign investors rush for local bonds. Well, let's start off the show in Zimbabwe, where authorities are trying to beat a 48-hour ultimatum set by civil servants to come up with an improved wage offer or face job action. Now, an umbrella body representing 16 unions had given the government up to Wednesday to make a new offer. Talks with government got underway late this afternoon, and CGTN's Farai Mwakutuya brings us the latest.
Protracted negotiations have so far failed to break a deadlock. Public servants insist on their minimum $1,700 wage demand, which government says is unaffordable. Currently, the lowest paid civil servant earns $414. A final meeting between the two parties was scheduled Wednesday.
Even before that last-ditch effort, the country's biggest teachers' union, the Zimbabwe Teachers Association, had given notice that its 40,000-plus members will be engaging in a strike beginning February 5th.
An unwanted distraction for a government that is trying to rescue an economy blighted by shortages of foreign currency, experiencing its highest level of inflation in 10 years, and facing an uncertain future after recent unrest.
So yes, in terms of prospects, they are not looking good at the moment because the economy has suffered serious shocks. But those prospects largely depend on the execution of the reforms that were communicated by the Treasury Department.
Finance Minister Professor Mthuli has begun cutting government spending and is aiming to stimulate production and win back international financial support. He's mooted the return of a local currency by year end and plans to start clearing a daunting debt burden.
Firstly, we need to stop unsustainable government borrowing, which is pushed obviously by the budget deficit. Then one of the key issues obviously is the prioritization of the forex that we get. We get on average, I think, 4.5 to 5 billion in terms of foreign currency every year, if we include remittances, gold, platinum, and tobacco exports. And if you look at that particular forex, what is important is that we need priority. We need to focus on how to channel that particular forex to production.
Zimbabwe's economy performed better than expected in 2018, expanding by 3.5%. Many here hope it can get over the early shocks of 2019 and repeat the feat. How authorities handle the current crisis and their adherence to very stringent austerity measures could make or break this precariously poised economy. Farai Mwakutuya, CGTN, Harare, Zimbabwe.
And to South Africa now, where retailer Shoprite says it expects its headline earnings per share to fall by 26%. And that, of course, is its biggest fall in almost 20 years. Now, the retailer warned of a steep drop in half-year headline earnings, citing foreign exchange setbacks as well as other factors. At market opening today, shares in Shoprite plunged more than 16% before paring losses to trade at 10.7% weaker at early trading today. Now, last Tuesday, Shoprite, which owns more than 2,800 outlets across Africa, reported a flat half-year sales, held back by a strike at its largest distribution center in South Africa and sharp currency devaluations elsewhere. Well, Sumitra Naidu now joins us in Johannesburg with more insight into this story. Sumitra, great to see you. Now, of course, a number of things the retailer has listed that have contributed to that 26% drop in first half earnings. They talked about a depressed consumer environment, as well as increased competition in its home market as well as abroad. So, Sumitra, what is the company now saying about its plans to regain that momentum?
Yeah, Uche, it's so unusual for Shoprite to have this long list of issues. As you say, a number of factors led to this profit warning. The company has always been consistent in recording healthy profits. Last year, though, was the first time in 20 years that the retailer posted a loss. So not completely a surprise here with this trading statement, but I think the market was rather disappointed. So, of the issues it listed was a new IT system that it implemented last year that took some time to settle and work as planned. So Shoprite says the implementation was complete in December, and it does expect that to help it go back to running effectively and efficiently. In terms of the other issues related to deflation and high costs, in the domestic market here in South Africa, the group says it is confident its customers will remain loyal. It's also hoping to get a handle on costs, which is also something new that's popped up in this trading statement. But again, some of these costs for electricity, for example, is hard to avoid with Eskom running at a loss and looking for higher tariffs. Power costs will remain elevated for some time. When I spoke to the CEO in August last year, he did say that they were now also starting to buy properties to house their stores, which is an added expense in the short term, but a good investment in the longer term. And of course, you avoid the higher rental costs. Uche?
Well, Sumitra, as we mentioned earlier, the firm's shares did fall as much as 20% on the news. That's the most in about 20 years. But the reality is that we've seen the stock down 33% over the past 12 months. So give us a sense of investors' main concerns with what is Africa's biggest retailer right now.
So, while the African expansion has always been a good move, it was hailed as a good move, some countries have proven quite tough on the retailer. Angola too, and the devaluation of its currency and rentals in some parts are all, charged in dollars now. The recent strength in the greenback, of course, weakened every other currency. So that was, not good news. But I think there is a bit of concern creeping in that this also could be an issue of new leadership. Slump impacted overall numbers. Nigeria too is showing little change. Hundreds of product items remain banned, leaving only about 50% of Shoprite's normal product assortment in the stores. So the group is unable to provide a wide variety to its customers there. In South Africa, it's the weak economic environment. Consumers are cash strapped here, and Shoprite appeals to the lower income market. This market is spending most of its income now to, on basic services, electricity, transport. They're also servicing debt. The recent rate hike is also adding to those rising costs. So consumers will remain under pressure for some time here as well.
Now, of course, we also saw other retailers in South Africa following Shoprite's lead on the market today. They didn't fall as much, but we did see Pick n Pay, Spar Group, Woolworths all registering losses today. Now, of course, all retailers in South Africa right now are expected to be hit by that tough trading environment. But are you expecting to see such disappointing results going forward?
I think to some extent, yes, same thing. Retail makes up about 60% of this economy. People are trying to make ends meet, pay off debt, keep the lights on. They're cutting back on shopping, clothing, furniture, appliances. These are now seen as luxuries at this point that one has to do without. Woolworths too, which appeals to the higher income earner. You're also seeing customers here becoming more prudent with their money, looking for cheaper options. I suppose it's bread and butter time now. The high unemployment rate doesn't help the situation here. Spending power is definitely declining, and these retailers are feeling it. And as we've seen in recent weeks, we saw a number of these retailers issuing similar profit warnings.
Well, many thanks, Sumitra, for that update. Of course, Sumitra Naidu joining us there in Johannesburg. Well, let's head over to Nigeria now. The government there has launched another initiative to increase domestic revenue, and that's after its voluntary income declaration scheme failed to hit set targets. Now, Africa's largest economy is looking to more than double its tax to GDP ratio from 6 to 15%. Here's CGTN's Kelechi Emekalam with more.
Another initiative being launched to improve domestic revenue collection in Nigeria. This one is called the Strategic Revenue Initiative. It targets big data, which means all data relevant to taxation will be collected from the banking system, customs, ports, and company registry will be made available to enhance tax collection. It follows the Voluntary Assets and Income Declaration Scheme, which failed to hit its target. The Voluntary Assets and Income Declaration Scheme expired last year, and Nigeria's Federal Inland Revenue Service was able to collect $14.6 billion, a significant rise from the $11 billion collected in 2017, but below the target of the government.
At the conclusion of it, we did find out that there are quite a number of people that did not take advantage of this opportunity. And based on information that we have, we first of all have linked up with the banking sector, and to our utmost dismay, we broke them into two sections. We had those that had banking turnover in excess of 1 billion naira annually for 3 years, and we found out that close to 6,000 businesses had not complied with the tax regulations. We went further down to 100 million to 1 billion, and the analysis that we have seen, we have a list of close to 75,000 accounts or businesses that have not filed or paid any taxes.
Nigeria's tax to GDP ratio is below its peers like Ghana, where tax to GDP ratio is at 16%. And its main source of revenue, crude oil exports, have proven very unreliable due to unstable prices in the global markets. Its government now wants to collect all taxable revenue to fund development projects. It has contracted international tax consultants to advise on how to maximize domestic revenue collection.
We are targeting the use of big data. That is to say, we are going to harness all the data that is available at FIRs and customs and CAC and the banks and several other agencies that house data that is relevant, that is related to taxes. The use of this data will be driven, of course, by an automation process. There is a new project that we call Project Lighthouse that is working to bring the use of this data, and FIRs will be leading on this Project Lighthouse. And very soon also we will commission Project Lighthouse.
Unlike the pragmatic approach under the Voluntary Assets Declaration Scheme, the Strategic Revenue Initiative will no longer depend on goodwill of potential taxpayers. It will be an aggressive effort to go after tax evaders using data from key business points. Kelechi Emekalam, CGTN Abuja, Nigeria.
Now look at our corporate headlines today. Workers from Kenya's Aviation Workers Union have issued a strike notice against the impending takeover of Jomo Kenyatta International Airport by the country's national carrier, Kenya Airways. Now the lobby group has cited that the takeover will lead to job cuts. If executed, the looming industrial action will paralyze operations at the country's main airport. And in South Africa, retailer Lewis Group delivered a strong sales performance following its acquisition of United Furniture Outlets for the quarter to end December. Now, the performance sent its shares up as much as 8.41%. The acquisition of UFO formed part of its strategy of increasing its proportion of cash sales and selling more goods to middle to upper income customers, while in turn reducing the risk of business. And former Nissan chairman Carlos Ghosn says the charges against him in Japan are the result of a, in quotes, plot and treason at Nissan. Now, Ghosn faces 3 charges of financial misconduct, charges which he has denied. His lawyer has said it's unlikely the executive will be released anytime soon. Now, observers say that it could take up to 6 months for the court to organize a trial, given the complexity of the case. And German firm Siemens has made a last gasp appeal to European antitrust authorities to approve its planned rail merger with France's Alstom. Now, Chief Executive Joe Kaiser argued that EU competition rules from the 1990s were from a different era that were now outdated. The merger aims to create the world's second largest rail company with combined revenues of around $17 billion. And that's a look at our corporate headlines today. Well, let's head into a quick break now. Still coming up on the show. A boon for Egypt's economy as foreign investors rush for local bonds. And counting the cost for South African Airways bailout plan.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business, only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back. Now let's go to Egypt now, where foreign investors have bought 30% of the country's local currency treasury bonds in an auction held this week. Now the country's central bank sold about $66 million in 5-year bonds at an average yield of about 17.6%. That's down from a yield of 18.03% at the last similar auction. At the same time, the Egyptian pound stabilized. It traded at an average price of 17.68 to the dollar after 2 days of consecutive appreciation that pushed it to a 9-month high. Now, the North African state is wrapping up its 3-year, $12 billion economic overhaul, which was an agreement with the IMF, and that's wrapping up this year. And staying in the country, American tech giant Apple is considering plans to directly invest in the North African nation. This emerged at the sidelines of the World Economic Summit in Davos after a meeting between Egyptian Prime Minister Mustafa Madbouli and the iPhone maker's CEO Tim Cook. Here's CGTN's Adel El Maroui with more.
Apple CEO Tim Cook told Egyptian Prime Minister Mustafa Madbouli that the tech giant is intending to directly invest in Egypt. According to a statement from Egypt's Ministry of Investment, Cook clarified that Apple is studying several management proposals and investment opportunities.
The announcement about Apple's interest is great news. Companies of that scale never take a step without an assured profit. Egypt's IT exports reached $3.5 billion in 2017, and the numbers for 2018 are even higher. Projects put technology here at $4 billion by 2020.
Apple definitely wants to open a store in Egypt. Cairo, however, wanted more involved in the economy. The Prime Minister offered the tech giant to join building a smart infrastructure of the new administrative capital or 14 other newly developed cities. Cairo is also moving forward with an ambitious plan to introduce some 750,000 tablets to school students every year.
Apple and other tech companies know that Egypt is a promising market. It has very well-trained youth in the fields of electronic engineering and computer sciences. The market is wide open, but I don't think there is room for a major corporation like Apple.
Apple has been preventing its Middle East distributors from selling to local Egyptian sales points. That has made iPhone prices go up to be 50% more than other countries in the region when offered at authorized retailers in Egypt. Cairo has given the company an ultimatum to resolve the issue. The deadline expires on February 11. If the situation is resolved and prices go down, Apple's phones and computer sales will definitely grow. And with about 38,000 iOS developers registered in Egypt, the opportunities for work here appear to be attractive. But will it be attractive enough for Apple to finalize an agreement? Adil Mahroui, CGTN, Cairo.
And moving on now, Rwanda's biggest brewer, Bralirwa Limited, is hoping to boost the sales of Heineken by brewing the beer locally. Now, Now, the firm has been importing the beer from Netherlands. The company aims to cut retail prices by a fifth, as well as boost its overall sales across Africa. At a recent event to mark the launch, the brewer's technical director says the company had invested about $10 million to get the plant up and running. The East African state is expected to join other African countries as the local producers of Heineken on the continent. Meanwhile, South African Airways has secured yet another loan of about $256.8 million to keep its business afloat until the end of its financial year in March. Now, the loss-making flag carrier is currently implementing a 3-year turnaround strategy in order to battle its cash flow challenges. CGTN's Angelo Coppola has more on that story from Johannesburg.
While the banks won't confirm any loans citing banking regulations, there's a misconception that South African taxpayers are going to land up footing the bill for any further bailouts for the national flag carrier.
This is Treasury backed and guaranteed, in other words, backed and guaranteed. Some people would say by taxpayers, but I make the point that they don't go and collect anything more from taxpayers. What they do is they divert the money from the poor, from social grants and from housing and schooling.
The South African-based banks have to look at the long-term picture and ensure that shareholders get investment returns and that any perceived risks are properly identified, managed and priced into any loans they provide to SAA.
So the banks just lend any amount of money to state-owned enterprises so long as they think the Treasury is solvent. When they stop bailing out state-owned enterprises, Denel, SAA, Eskom and so on, then you must realize they've decided actually the Treasury is insolvent. That's very serious.
While SAA management have a turnaround plan in place and are working to milestones, their time is running out. Many analysts and commentators have called for the airline to be placed under business rescue.
So what you want to do is negotiate your way out of that test in the best way you can, out of the lease agreements on planes. Sell off, if you can, SA Technical, which itself is rife with corruption and incompetence and inefficiency, and theft, even to the point of stolen aeroplane engines. I mean, we're not talking small stuff here.
The airline itself has been tight-lipped about whether it has the bank loans or not, only saying that it won't comment until the matter has been resolved or settled. As the airline limps from month to month trying to make ends meet, there's still no clarity on whether it has that money or not from the South African banks. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
Now, the volume of private equity deals flowing into East Africa recovered in 2018, nearly doubling to $834.3 million. That's up from about $446.8 million the year before. Now, the cash has mostly gone to traditional private equity sectors that include education, manufacturing, as well as technology. However, creative industries like film, music, fashion, as well as esports are now emerging as new investment destinations. Here in Kenya, Heva Enterprises has announced 3 funds which will be targeting either seed stage capital or longer-term debt for medium-sized businesses. While CGTN spoke to the fund's managing partner, George Gashara, about investing in creative industries in East Africa.
Right now, a lot of our clothes in the region are second-hand European hand-me-downs.
Pretty much.
We are importing over 100,000 metric tons every year, but we want to start to stimulate local production of fashion. And we have a lot of brands that are trying to offer specific products, whether they're high-value products or eco products and anything in between. We are starting to invest in manufacturing and retail. We already have prototyped with 3 factories, and going into 2022, we want to move close to 500 million shillings into that space. There's limited opportunity to scale to market, or the path to market, and so you find we have a sprawling ecosystem of, say, web developers, app developers that cannot integrate into the Google Play Store because Africa doesn't have merchant accounts, and so there's a whole lot of IP that goes to waste because there's no investment track for that. And so if you think about gaming, a lot of games that are able to be sold in this ecosystem are sold through credit cards that are international credit cards, or people buy from Dubai, but then we still consume. If you look at consumption trends for like the Middle East, it includes Africa, because a lot of our business people go to China and the Middle East to buy products, and so the sales are magnified in the Middle East, and Africa is obscure. Look at the entire sum of revenues to the artists. A lot of them come from live music performance. And so as a fund, our music strategy, especially around investment, focuses on creating a high-quality East African music circuit. That's a live music circuit that allows audiences to pay tickets in advance, to spaces to host regular programs, and to also coordinate around the region so that one artist can be signed in one circuit and they can finish their year doing 5 to 10 major gigs, which would secure their annual income.
Well, let's head to Lesotho now. Wool and mohair are the country's main agricultural exports. However, a new regulatory law by the country's government is placing the $100 million industry at the center of controversy. With more on this, here's CGTN Sumitra Naidu.
Lesotho's $100 million wool and mohair industry is the lifeline of 50,000 small stock farmers. The industry employs around 350,000 Basotho people. But for more than 40 years, trading of these fibers was done across the border in South Africa. The government has implemented new laws to bring all trade back to Lesotho.
Now, the really selling of the wool will be done here. The buyers will come directly to buy from Lesotho, either through internet or they come in person to come and do the buying here. They can buy online, they can fly to Lesotho, whichever way they want for auction. The wool must be sold from Lesotho.
The move is aimed at uplifting farmers and growing the local industry. Wool and mohair farmers now have to obtain trade permits and sever ties with South African brokers who have years of experience, especially with international trade. The government says farmers have been subjected to unfair trading practices for too long and have not benefited from these prices.
We are going to control the prices because Basotho, the really farmers were been paid less for quite a long time, because for AH is the best grade, but our farmers, they are the lowest people in terms of having money. They don't have money, but they have plenty of livestock, of sheep, but they don't have money. We don't like that. Only the middlemen have money out of those people's sweat.
Construction of a new wool centre near the capital Maseru has just been completed. It will become the central point for all wool farmers.
Lesotho is one of the largest producers of wool in the world, and it produces some really good quality wool. It's also a big producer of mohair. The texture is a little bit different, but it's also quite a luxurious material, and it's more expensive than the wool. It sells for about $20 a kg.
Produce 5,000 tons superfine merino wools. So what our wool store doing here is we collect the wool and we auction the wool here, and then we also export our wool directly from here to overseas factory. We cut a lot of middle cost. That means we save a lot of money for the farmers. Not only the price we will sell much better price, but also we will pay quickly. Also, we save the transportation for the farmers.
Lesotho is on a massive investment drive to grow new and existing local industries. It wants to create more employment and reduce poverty. But many farmers are not happy with the new regulations and are afraid they will lose their businesses. Sumitra Nadu, CGTN, Maseru, Lesotho.
You're watching Global Business Africa. Let's head into a short break. Still to come. Talks to end that trade dispute between China and the US take off in Washington. And we assess the impact of the unfolding crisis in Venezuela.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
Just about 1:30, let's recap today's headlines. In the Horn of Africa, the death toll from 2 sunken migrant boats has risen to over 50, but dozens are still feared missing. The incident took place off the coast of Djibouti. Now, according to the International Organization for Migration, 2 vessels carrying migrants departed from Godoria in the country's northeast coast on Tuesday morning, but they sank in heavy seas just 30 minutes into the journey. 16 people survived in the incident. Meanwhile, Ethiopia's defense forces have continued with their airstrikes against Al-Shabaab militants inside Somalia. In the offensive, Ethiopia says it has completely destroyed at least 4 Al-Shabaab armed convoys. Now, the airstrikes have been centered in Burhakaba, a town located in the Bay region of Somalia. The federal army claims 35 Al-Shabaab militants were killed during the assault. And the World Health Organization says there has been an increase in reported cases of Ebola in the Democratic Republic of Congo. That's in its North Kivu province. The UN agency says response teams have faced pockets of community mistrust in the Katwa health zone. Now, UN spokesperson Stefan Dujarric says the outbreak is also extending southwards to the high security risk area of the Kaina health zone. And the European Union says the Brexit deal is not up for debate. The bloc's leader, Jean-Claude Juncker, says the current plan is the best and only deal possible. He also insists it will not be renegotiated. Now, the British Prime Minister is pushing the European Union for a better Brexit deal. On Tuesday, Parliament approved an amendment which abandoned a pact that May had reached with 27 European leaders last month. And that's a recap of today's headlines. Now, another round of trade negotiations between China and the U.S. has continued. Chinese Vice Premier Liu He is in Washington with a delegation. A lot will be at stake when the two sides finally meet. The result of the talks will have a major impact on the course of China-U.S. trade relations going forward. High on the agenda will be whether the ongoing trade war can be brought to an end, whether disputes around intellectual property rights can be resolved, and how the Chinese government can further support foreign companies. Well, the impact of the talks will be felt by companies in the high-tech sector and in the overall environment for U.S. firms doing business in China. Well, let's get the latest on the ongoing talks. Nathan King now joins us in Washington. Nathan King, great to have you on the show. Now, of course, White House officials are saying that the two sides still remain pretty much far apart on the key issues, while of course we hear the U.S. side is still engaged in its own internal debates over how to proceed. Looking at the cards on the table, Nathan, is it likely we will see any meaningful progress in these talks? And certainly, what are the biggest obstacles to that happening?
Well, first of all, you're absolutely right about the divisions in the U.S. negotiating team. You can actually see it in the room as these two sides got together just a few meters that way on a building attached to the White House. Peter Navarro, the big China trade hawk and advisor to the president, had a very sort of sullen face, while others joked with their Chinese counterparts, including Liu He, who of course a lot of them had met each other in Buenos Aires at the G20 when Donald Trump was there, US President and Xi Jinping, and basically negotiated a pause in this trade war. Now, you're absolutely right. The sticking points have been, from the American side at least, the same. While they want China to buy more US goods to bring down a trade deficit, they're also asking for structural reforms in the Chinese economy that would address what the US concerns are: intellectual property, forced technology transfer, partnerships, and US firms being able to essentially go it alone in China without them. Now, for the Chinese side, they have said that these reforms have been coming for a long time, that they're taking their own pace. In fact, China just in the last 24 hours has announced a new investment law that's going to come up at the two sessions, legislative session at the beginning of March. So there are these hopeful signs. Remember, also China's lowered tariffs for autos since the G20 meeting. So there is some sort of framework for a deal, but the question is whether the US president goes for it, because on the one side we have China hawks that want China to change its economy far beyond the Chinese government's ability to do so, and then we have others who, like the Treasury Secretary, for example, Steve Mnuchin, who's also in the room, who think that increased purchases of US goods from China would help, and some structural reforms, and also perhaps some movement by the US on Chinese concerns. So that's where we are. The real decider, as we all know, is behind here in the White House. He will meet Liu He, the Vice Premier, as these talks wrap up, and that will be sometime in the afternoon local time here on Wednesday.
Now, of course, there's that move by the U.S. Justice Department to level criminal charges against Chinese tech giant Huawei. How have we seen that impact on the mood around those talks?
Well, it's not helping in terms of the Chinese attitude to this talk. You only have to look at Chinese media. You only have to look at Chinese internet to see how angry people are in China about this. And, you know, the timing is quite incredible, isn't it? Just as Liu He and his 20-man negotiating team were landing here in Washington, we saw a press conference attended by the acting Attorney General, the Homeland Security Secretary, the FBI head, the Commerce Secretary, all to announce the extradition proceedings, of course, of Meng Wanzhou, but also charging Huawei as a company as well. That was a very big show by some top brass here, White House officials, and was not lost on a lot of us observing that, thinking this is obviously a commitment by the White House. But the White House and others say it's entirely separate, it should be seen separately. But as we know, behind these trade talks and behind the talk of tariffs, behind the talk of restructuring the economy, is essentially a real worry by the US that China could become a big competitor in the industries of tomorrow. And we're talking, of course, about 5G, where Huawei is a leader, artificial intelligence, robotics, other ways. And some are seeing this as a way of the US making its point by trying to stop the rise of Huawei. We'll wait and see. But whether this is a leverage, I mean, even the US president has admitted that Meng Wanzhou could actually be used as a leverage chip. We'll have to wait and see. But for now, there is optimism in the room, largely because, remember, all those tariffs that were imposed by the Americans are still sitting at a 10% level. They're due to kick up to 25% on March 1st. There is a little bit of wiggle room at the moment. But remember, that negotiating period has about a month left.
That's right. And of course, if those talks fail ahead of that March deadline you're talking about for U.S. tariffs to rise to about 25%, give us a sense of what could happen.
Right, at the moment, about $250 billion worth of Chinese goods is under tariff. We had the first 50 billion, remember, that was at 25%. Then we had 100 billion at 100 billion. That's at 10%. Due to kick up, as you said, to 25% come March 1st. Now, that could be extended. The US president has said that, so that could leave time for more talks. But if they did get ratcheted up, well, you saw the wobbliness around about the G20 in the US stock market. We saw declines of about 20%. A lot of tech firms have got hammered, and a lot of things could get more expensive very quickly. Now, the US has talked about having carve-outs for certain piece of technology. It's called the iPhone clause, if you like, perhaps not targeting favored consumer brands with their tariffs, but still, it would get rid of all the goodwill that has slowly built up since the Buenos Aires meeting, and essentially take everyone back to square one. And you know, China, a lot of people say, well, they don't import as much from America as the US imports from China, but it too could retaliate in terms of slowing down granting of licenses, for example, for US businesses. It could slow roll things, make it a bit more difficult for US firms to be competitive. All those things could really have an effect on global trade. Now, we saw at Davos, and we've heard from the IMF, that this trade war is essentially the #1 worry of the global economy. And when we're seeing a slight wobble in demand, the last thing you want from the two largest economies is a trade war.
Quite right. Well, many thanks for your insights, Nathan. Of course, Nathan King joining us there in Washington, D.C. Well, as trade disputes between China and the U.S. are yet to be resolved, more investors are now eyeing Southeast Asian countries for their supply chains and production to lower costs as well as gain better investment returns. But as CGTN Silkina Al-Hulwalia reports, it's not all positive. The ongoing trade dispute between the United States and China have caused investors to shift their money elsewhere. According to a survey at the Asian Financial Forum, Southeast Asia is experiencing a boom in foreign direct investments, becoming the region most likely to produce the best investment returns. Several companies are now moving their supply chains and productions into Southeast Asia, particularly Indonesia and Vietnam. This, in turn, creates massive opportunities for the people in the region.
We think that Southeast Asia can promote or can offer robust economic growth. As we know that IMF in 2019 expect that ASEAN 5, including Indonesia inside, actually can grow around 5.1%. Basically still attractive compared to other regions in the world. And secondly, I think Southeast Asia can offer also labor force. As we know that ILO mentioned that by 2030, it can add around 60 billion or 60 million laborers for workers in Southeast Asia region.
Those factors contribute to investors' confidence in pouring their money into the region. Research shows the region's internet economy is also predicted to exceed $240 billion by 2025.
So the younger generation which
have a very good, now a better education. Now they are more computer literate. They are heavily connected with easily with the information of technology. Looking for the position of the Indonesia among the ASEAN. We are the only ASEAN member who is also the G20 member. So this one creates a good demand for the digital economy.
Wisnu says Indonesia is also working closely with neighboring countries and have significant relationships with international businesses, which automatically improves the country's investment climate. However, Indonesia is still not immune to some implications of the trade war.
Actually, we have already experienced last year that our exports to China is weaker. The pace of growth slower in 2018. On the other hand, the imports from China becomes larger and larger. So it will lead the widening current account deficit or trade balance from China. So basically, we recorded that last year our trade balance with China widened to deficit 14 billion. So compared to previous year, maybe still around 11 billion.
That will negatively impact Indonesia if the government does not come up with a strategy. Joshua suggests promoting the country's natural resource industries, such as coal and palm oil. Sulkina Alawalia, CGTN, Jakarta.
Meanwhile, in Venezuela, international pressure is building as the United States slaps new sanctions against the country's state oil company, PDVSA, in an effort to push President Nicolas Maduro from office. Now, many Venezuelans are backing self-proclaimed president, opposition leader Juan Guaido, hoping for economic change. While CGTN's Juan Carlos Lamas reports from Caracas.
Venezuela is home to the world's largest proven oil reserves. The new round of U.S. sanctions imposed on Monday is a punch to the country's lifeline. Last year, Venezuela sold more than 500,000 oil barrels to the United States each day. U.S. refiners are among the few that pay cash for Venezuela's oil. But the new sanctions against PDVSA, Venezuela's state oil company, mean that cash will likely dry up. The U.S. can continue to purchase Venezuelan oil, but the payments must be held in an account that cannot be accessed by Maduro's government.
PDVSA has long been a vehicle for embezzlement, for corruption, for Venezuelan officials and businessmen. Today's designation of PDVSA will help prevent further diversion of Venezuela's assets by Maduro and will preserve these assets for the people of Venezuela where they belong.
After the sanctions were announced, President Maduro accused the U.S. government of stealing Citgo, the PDVSA refinery in the U.S.
I have instructed the president of PDVSA and Citgo's owner to start legal and political actions in U.S. courts and around the world to defend our property and Citgo's wealth.
The U.S. says the sanctions have nothing to do with stealing wealth. They are about forcing Maduro from office in order to bring democracy back to Venezuela. The U.S. says it will lift the sanctions once Maduro's government hands control over to opposition leader Juan Guaido, who would use them to help establish a new government.
With these new sanctions, Venezuela won't receive most of the money it used to obtain from selling oil barrels. Therefore, there's going to be a lack of dollars necessary to buy and import all goods here in Venezuela, leaving this country in a desperate situation.
Millions of people have been coping with hyperinflation and shortages of basic food and medicine since Maduro became president after the death of Hugo Chavez in 2013. Many hope that political change will bring economic relief.
Now you can see them going out onto the streets just to survive, and now you can notice that they are hopeful. People here before didn't have any hope.
Venezuela's opposition has called for a show of support, with tens of thousands of people planning to take to the streets this week to demand a stop to the economic free fall and a new beginning. Juan Carlos Lamas, CGTN Caracas.
And moving on now, a selection of dazzling diamonds and high-end jewelry have been displayed at Israel's International Diamond Week in the capital, Tel Aviv. Now, according to experts, the country's diamond market now appears to be stable following years of upheaval caused by new regulations.
Dazzling diamonds and busy dealers. Israel's International Diamond Week is in full bling. The country's net polished diamond exports stabilized in 2018, totaling $4.5 billion.
The diamond business is going through a lot of changes in the last few years, and especially in Israel. However, 2017 was the first year of stabilizing the business. 2018, we're starting to go into increase, and we're looking forward for an increase in the business over the next years.
Spiro says the crisis in the market was caused by new rules of transparency around the world. But now everything has settled down and investors are more willing to travel far for the opportunities.
This is the biggest show that is there in Israel, and Israel being the biggest diamond market as it is, and so they're one of the biggest traders, one of the biggest manufacturers. So it just made sense to be here and to promote ourselves, to be buying as much as possible. From a selling perspective, it's a very good platform.
For Israel-based diamond dealers, the show is an ideal platform to meet new buyers.
First of all, the initiative is amazing because we see a lot of buyers from outside, and on top of that also the local merchants. It's a great opportunity for us to meet, talk, mingle, which we don't get on a normal basis. Business-wise, we've done some significant business, so I'm very happy.
Those involved with the diamond trade hope that now that new bank and tax regulations are in place, their business will bling again. Xia Cheng, CGTN.
And on that note, let's take a look at how commodities performed today. Now, oil prices held steady, boosted by concerns about supply disruptions. That, of course, is following U.S. sanctions on Venezuela's oil industry. But traders do say they still were pegged back by a bleak outlook on the global economy. Meanwhile, gold prices edging up today to their highest since May. They were supported by uncertainty over U.S.-China trade relations, as well as the expectations that the U.S. Fed will keep rates on hold later today. Well, let's take a quick break now. Still to come. Kenya's youth are eyeing the global fashion industry with classy wooden sunglasses.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Now, a Finnish company in Kenya is creating jobs for youths from disadvantaged areas in the country's capital, Nairobi. The company produces quality sunglasses out of wood. Well, CGTN's Penina Karibe takes a look at how this workshop is turning around lives, one pair of sunglasses at a time.
At a glance, it doesn't look like much is going on here. But this is a workshop for Shade Shares, a Finnish company that produces quality sunglasses made of wood. The company started its production in Kenya last year in May, and its uniqueness lies in its workforce.
It's a company that helps the youth from disadvantaged areas, and it helps them in the sense that it gives them livelihood and a place where they can come and be busy. Also, it gives them a place where they can come and learn a new life skill.
Shade Share's 15 employees live in the sprawling Kariobangi slums in Nairobi. They are in their early 20s. Most of them didn't complete their high school education, and some, like Rayvon, are reformed criminals.
Most of my friends are dead. They were shot dead. Others are in jail because of the criminal activities they engaged in. So I decided to grab this opportunity, and I proved to the management that I can change, and here I am.
I was a mobile salonist braiding and unbraiding hair, but I did not have many clients. For example, once you braid your hair, you will not undo it in the next day. So in a month, I would get very few clients, and it was hard to cope.
For 3 months, they all underwent rigorous training on how to produce a quality product that would compete with already established brands. The raw materials come from Finland, but the entire production is done in this workshop. From designing the sunglasses to cutting them, polishing and fitting the lenses, it is a meticulous process that sees them produce on average 60 pairs of sunglasses a day. For most of us, wearing sunglasses is almost second nature. They're a useful pair to shield you from the harsh sun rays or just simply to look cool. But for this group of youth involved in these sunglasses production, they're literally a lifeline.
This job has really helped me. First of all, I no longer hang out with that bad company. I pay my own bills, including rent. Now I have a family and I provide for them. If it wasn't for this job, I don't know where I would be. I would probably be dead.
I'm a mother of one son, 1 year, 8 months. So at least I'm renting my own house.
Their clients are mainly in Europe, but they are hoping to break into the Kenyan market mid this year and have partnered with brand ambassadors to market these wooden glasses.
The biggest advantage is it's not plastic. That's number one. Number two, it's biodegradable. Plastic is not. Number three, you're saving the environment. In that, where we get our pieces of wood, the trees are felled to create space for other trees to grow.
One pair retails at $70 and the company says 20% of every pair sold is directly spent on supporting the professional education and employment of young people living in the Kariobangi slum. Penina Karibe, CGTN in Nairobi, Kenya.
Now, before we go, let's check in on Africa's currencies today. We saw Kenya's shilling easing against the dollar, and that's due to increased demand from oil and goods importers who are now buying dollars to meet end-month obligations. Meanwhile, South Africa's rand little changed against major global currencies, but we did see it holding on to most of its overnight gains against the sterling, as of course markets digest new Brexit developments over in the UK. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Uche Okoronkwo, and of course the rest of the team, thanks for watching.